Good evening, members and guests, and welcome to LGIAsuper's very first Women in Superannuation webinar. My name's Kate Farrar. I'm the CEO of LGIAsuper, and I'm here tonight with Gabrielle Williams, who's one of our financial advisors here at LGIAsuper. Tonight, we're going to be exploring the superannuation gender gap, and over around 25 minutes, what we'll be doing is covering a series of topics that are of real interest to our female members when we speak with them. After that, we're going to be answering your questions live. At any point throughout the webinar this evening, please feel free to ask a question by clicking the button on the top right-hand corner of your screen. Tonight we'll address as many questions as we possibly can. We want it to be really relevant for you, so we really look forward to hearing from you. The first part of the seminar will be presented by Gabby Williams, who's worked in financial planning for over 14 years now. As you can imagine, during that time, Gabby has helped many women to achieve their best possible retirement through their superannuation. Welcome, Gabby.
Thanks, Kate. Welcome and thanks for joining us tonight. So tonight I want to try to answer some of those common questions that I get asked when I tell people I'm a financial planner. So the big one being, how much money do I need for a comfortable retirement? And then have a look at some strategies for closing that gap and getting a little bit closer to that goal. Then I'll do a little bit of a comparison between paying off your mortgage or putting extra contributions into super. I'll hand back to Kate to give you a bit of a market update and let you know a little bit more about how your super's invested. And I'll wrap up with a quick segment on wealth protection because unfortunately it is an important part of planning for retirement. Just a quick warning before we start, what we talk about tonight is general information only. So if you are planning on making some changes to your super based on what we talk about tonight, please have a read through the product disclosure statement, make sure it's right for you. And if you've got questions, give us a call. Our representatives are happy to help and answer questions. On a bit more of a personal warning note, I am about 7 weeks off of giving birth, so if I make a funny face or a funny noise during the presentation, apologies, someone's probably just decided to give me a good kick. So let's start with the big question that I get asked all the time. Whether I'm at a party or a wedding or a funeral, people come up and ask, how much do I need to fund a comfortable retirement? Now, unfortunately, I don't have a black and white answer for you because it all depends on personal circumstances. Depends on, how much you want to spend in retirement, when you want to retire, and how comfortable you feel being a little bit reliant on Centrelink. But I will give you a little bit of guidance. So we refer back to the Associations of Super Funds Australia, or ASFA for short, bit of a mouthful, but they actually go out and they poll retirees on what they're spending on a quarterly basis to try to give us an idea what a modest and a comfortable lifestyle looks like in retirement. So the figures that they've come up with is a modest lifestyle is about $28,000 a year for a single person and about $41,000 for a couple. So that's a little bit more than the maximum age pension. So you're going to need a little bit in assets on top of the age pension to hit that modest lifestyle. But I think most of us are hoping to do a little bit better than that. We're hoping for that comfortable lifestyle. So for that, they say about $44,000 a year for a single and about $62,000 for a couple. So what does that comfortable lifestyle look like? It should allow you to pay for some of those extra luxuries in life. So keeping your private health insurance going, driving a fairly up-to-date car, being able to update your household goods and appliances, being able to participate in some recreational activities, whether that's going out to dinner or playing golf or spoiling the grandkids, whatever is your preference. It also allows a little bit for a domestic holiday each year and probably an overseas holiday maybe every 3 years or so when we're actually allowed to do that again anyway. So what do you need to have available to fund that comfortable lifestyle? Again, it sort of comes down to what the age pension looks like, which is a really difficult question to answer. But if we have the age pension the way it is at the moment, a single person needs about $350,000 in their super or about $450,000 for a couple. But if you want to take age pension out of the picture entirely and just self-fund everything, a single person probably needs about $680,000 and a couple about $950,000. Now in reality, most of us are probably going to fall somewhere in between that figure because there will be some age pension, but we're not really sure what it's going to look like. Another thing to keep in mind is these figures do assume that you retire when you're 67 and that you've fully paid off your home loan. So if you want to retire a little bit sooner than that, like most of us, or if you think that you might still be renting or paying off a mortgage in retirement, you do need to allow a little bit extra. So what do we know? Unfortunately, we know that there are a lot of unique challenges that face women in getting to that retirement balance. So, we tend to take time off work or work part-time when we're raising kids, but also later on in life when parents need care, it tends to be us daughters who step in and do that. If we get divorced during our lifetime, we tend to sort of come out of that a little bit worse off because we're the ones who are raising the children. And even if you get child support, it's often not enough. When we are at work, we also tend to get paid less than our male counterparts, which is a whole separate webinar, and I won't get started on that at the moment. We also live longer than the gents, so we've probably got an extra 5 years of retirement to fund. So all of these challenges, at the moment, the average woman who retires between the ages of 65 and 69 retires with about $170,000 in her super. So it's about half of what we wanted for that comfortable retirement. So what can you do to close the gap? I would start off by checking if you actually even have a gap. You might be doing a lot better than you think. So log on to the LGIAsuper website. We've got a retirement income calculator. So you can put in your personal details and it'll give you a projection for the kind of retirement income that it thinks you can fund. And you might find that you're actually doing a lot better than you thought. But if there is a gap, or if you'd just like to be doing a little bit better, what can you do about it? For this slide, I use a bit of an example client. So I've got my example client, Tina. She's 55 and wants to retire at 67. So, we've got about 12 years to work with. She's got about $150,000 in super at the moment and just gets standard 9.5% employer contributions. She's currently earning $60,000 a year, so takes home $46,000 after tax. So how is she tracking towards retirement? At the moment, if she just gets the 9.5% employer contributions, she's probably on track to fund about $39,000 a year. So it's not too bad, but it's not that comfortable lifestyle that we wanted, and it's certainly less than she's been earning while she's been working. So what does it look like if we add an extra 6% salary sacrifice for the next 12 years? Now, I picked this number because I know that a lot of you out there watching tonight are probably doing a similar amount to your super already. If you work for council, maybe 5 or 6%. So this allows her to now fund $41,000 a year. So getting a little bit better, but still not quite where we want to be. So let's consider another scenario. Extra 6% salary sacrifice, and then putting her future pay rises into super as well. So for these pay rises, I'm not assuming anything too drastic, just 1% above inflation, and putting that extra amount into super. So still keeping her same cost of living for now. Now we're looking at being able to fund about $43,000 per year. So getting pretty close to that comfortable lifestyle that we wanted and pretty close to what she was getting while she was still working. I think it's really a matter of making small changes where you can just to build up a little bit extra. Now I know what a lot of you are thinking. With COVID this year and everything that's going on in the world, I don't think any of us are expecting a pay rise this year and maybe not even next year. So we might have to look around a little bit harder to find those extra contributions. So this slide is having a look at all the things that the average Aussie household wastes money on. Now hopefully you're having a look at those boxes and you're thinking, no, that's not me, I don't spend money on that, that's all fine, which is great. But there's probably a couple up there that strike a guilty nerve with you. I know for me personally, it's the $8 billion wasted on food. I think they say the average household throws out about 25% of what they spend on food. And if you took a look at my fresh produce drawer, you'd probably agree that that's about right. There's also about $5 billion spent on clothing. Again, this is a bit of a guilty thing with me. I don't know how many black dresses one person needs, but in my case, it seems to be always just one more. But certainly take a look at your own budget and have a look at if there's any places where you can reduce expenditure. It might be, cancelling that gym membership you haven't used for months, Or maybe the kids are coming to the end of their schooling and now you've got some school fees that are freed up. Basically, you need to be in a position where you're spending less than you earn before you can make any real progress. So how do you find those extra things that you're spending money on? Well, I'm sorry, but I'm going to tell you that you should go and do a budget. I know this is everyone's favourite topic and people hate talking about budgeting. Well, some of you out there might have an Excel spreadsheet that you put all of your expenditure in and you love talking about your budget, but for most of us, it's a painful experience. Believe me, I know. When my husband and I found out that we were expecting another baby, we had to go through and put together a budget again, and it almost ended in divorce, but we got there in the end, and we've got a budget that we can work with moving forward. So how can you start? Hop on the LGIAsuper website again. There's a great new section called Let's Learn, and there's these learning modules on all kinds of topics. Start with the one on budgeting and money management. Those are good base ones, but they're all very interesting. That has some great links through to some budgeting tools to get you started. My favourite is the Money Smart one. So that one suggests lots of different things that you might be spending money on. You can put in whether it's weekly, fortnightly, monthly, etc. And the thing I really like is you can save a version and then you can save a second version. So perhaps you've got one for what you think you're spending at the moment and one for what you'd like to be spending. Or in my case, I had one before baby and one for what I think it's going to look like after baby. The second step of budgeting is tracking your expenditure against that. So again, there's some links through to some budgeting tracking apps that you can put on your phone. Some of them require you to put in your expenditure every time you spend something. Some of them sync to your bank account. I'm not sure how comfortable I am with that, but certainly if you feel comfortable, go for that. Personally, I like to pull out my credit card statements once a month and put everything through then. Otherwise, I tend to forget things. So a few things to consider to grow your super. If you do leave council, consider whether you can keep doing your 5 or 6% contributions. It will make a big difference to your super balance when you get to retirement. Next time you get a pay rise, have a think about whether you can put a portion of that towards your long-term savings. Put together a budget and don't forget to budget for the fun things. It means next time you go out to dinner or you go on a holiday, you don't have to feel guilty because you know you budgeted for it and it's part of the plan. If you're coming up to the end of paying off a debt, think about whether you can put those loan repayments towards your long-term savings before you get too used to having that extra income. Okay, so let's say you go through the whole process of putting together a budget and now you've identified a little bit of surplus. So no doubt your question is, well, I've still got a mortgage to pay. Should I be paying that down or should I be putting extra money into super? Now again, unfortunately, I don't have a black and white answer for you because it really comes down to personal circumstances, but I will talk a little bit about the pros and cons. So let's start with the pros of paying down debt. So if you've got some of those smaller high interest debts like credit cards or personal loans, they can be a great place to start because you know that you're getting a better return because of the higher interest rate on them. It can also have this really great positive snowball effect. You pay off a credit card, you clear up some surplus, and now you feel ready to tackle that next financial challenge. Makes you feel empowered and ready to go into the next thing. The other nice thing about paying down debt is you know exactly what your returns are going to be. It's basically whatever interest you were paying on the debt, that interest saving is your return. Whereas if you invest somewhere else, whether it's inside super or outside super, returns can be volatile, so you might not be too sure what they're going to be. The other nice thing is interest saved is not income, so it's not subject to tax. You don't have to pay the ATO or anything on it. If you go and invest outside of super or even inside super, there is tax to pay on any investment earnings that you earn. And probably the most important one for most people is depending on your home loan structure, if you do make extra repayments, you can probably still access that money either through a redraw facility or an offset account or something like that. So you know that those extra repayments are available for a rainy day. So what's the big advantage in contributing to super? Quite simply, tax savings. So if your salary is somewhere between $37,000 and $90,000, you're like most of us and you're in that 34.5% tax bracket. So that's what I've decided to base my example on. But keep in mind that if you earn more than $90,000 a year, your tax savings are actually going to be higher than what I'm showing. So in that sort of tax bracket, for every extra dollar that you've got to put into your mortgage, you've already paid almost 35% tax on that. If you were to salary sacrifice that to super instead, you only pay a tax rate of 15%. So what does that look like? Again, I'll use an example. So let's say you go through the process and now you feel comfortable that you've got $100 per week that you can start putting towards long-term savings. What that means is you probably earn $150 that week, but you get $100 in your hand after tax. So that's what you've got available to pay down your mortgage. If you were to put that $150 towards super instead, because of the lower tax rate, you'd actually have $130 go into your super. Now, I know that doesn't sound very exciting, $130 per week compared to $100 per week, but let's have a look at it over the long term. And keep in mind for this scenario, when I've done comparisons, I've assumed a 4% interest rate on your home loan and a 4% investment return on your super. In reality, depending on how your super is invested, I'd actually expect your super to do better than mortgage interest rates, but I just really wanted this example to be about tax savings. So over a 10-year period, that extra $100 a week going into your home loan, that means you've now paid an extra $62,000 off your home loan. If you put that same money into super instead, now you've built your super balance by an extra $81,000. So over a 10-year period with the same returns, putting money into supers come out about $20,000 better off. And remember that both these scenarios feel the same when you look at your cash flow surplus. It's exactly the same amount of spending that you've got available to you. Now, before I mentioned that one of the problems is that us women tend to take time off work or work part-time, which means we don't have as much going into our super during those periods. But there are a couple of special benefits and incentives available out there if you are on a lower income for a period of time. So the first one I wanted to talk to you about is the government co-contribution. So for this one to get the full benefit, you've got to be earning less than about $39,000. The way it works is you put $1,000 into super as an after-tax contribution, and the government will match that with up to an extra $500 paid into your super. So that's a 50% return on your money. I can't think of anywhere on the market where you're going to get something that good. And there is a partial benefit available up to about $54,000 a year. The second contribution is spouse contributions. So this works really well if you're partnered and one of you is earning a little bit less and one of you is on a higher income. So in this case, if the lower income earning spouse is earning less than $37,000 a year, so remember, it could be hubby who's earning a little bit less. If you make a $3,000 after-tax contribution, then the higher income earning spouse can claim up to a $540 tax offset. And there's a part benefit that applies up to earnings of about $40,000 a year. A few important distinctions between these two contributions. For the government co-contribution, you do have to be working at least a little bit, and you do need to lodge a tax return because that triggers the ATO to pay that extra amount into your super. As far as the contribution is concerned though, it's just a normal after-tax contribution. You can arrange it through your employer or you can just pay it straight into your super. For the spouse contribution, there is a special BPay code. So if you log into your member online account, you'll see that there's 2 BPay codes. And the higher income earning spouse does need to remember to claim the tax offset when they do their tax return at the end of the year. But for this one, you can get the benefit even if the lower income earning spouse isn't working at all. So just a few things to consider if you're sort of going through a period where things are a bit lower than normal in particular. So when would I recommend super? When should you be considering that? I'd want you to have a salary that's high enough so that you get a good tax incentive from salary sacrificing, or maybe you're eligible for some of those incentives I was talking about on the previous slide. I'd also want you to be in a strong financial position, which really just means that you're happy to have those extra contributions locked away until at least age 60, because we're probably not going to be able to touch it before then. So maybe you've got a little bit of cash reserves or a little bit of redraw available in your home loan. I'd also want you to be comfortable with the fact that super investment returns can fluctuate. Like I said before, I do expect that super would outperform mortgage interest rates depending on how it's invested, but there are going to be positive years and there are going to be negative years, so you've got to be happy with that fluctuation. And lastly, super is a great place to lock away your money if you're a little bit worried about your spending discipline. Unfortunately, there's no point putting an extra $100 per week into your mortgage if at the end of the year you're going to take it all out again and go on a holiday. You haven't really made any progress then towards your long-term savings. You save for your holiday, which is great, but the nice thing about super is you know it's locked away until at least age 60, so it's really there to fund your retirement. And in all honesty, it's probably going to be a combination of the two that's the best for most people, but I just encourage you to have a plan. So log on to your online banking, have a look at when you're on track to pay off your mortgage. If you're on track to pay it off before retirement or at retirement, then you might feel a little bit more comfortable putting more money into super because you know that your home loan is taken care of. I'm going to hand back to Kate now to give you a little bit of a market update and just run you through where your super's invested.
Thanks very much, Gabby. If you've just recently joined us, my name's Kate Farrar and I'm here with Gabrielle Williams, who's one of our advisors, and we're covering topics related to women and superannuation. In a few minutes, we're going to be answering your questions live, so please submit your questions by clicking on the button on the top right-hand corner of your screen. So now we're going to talk a little bit about investments, which is something that's dear to everyone's heart. 2020 so far has obviously been absolutely unprecedented as the world has faced the COVID-19 pandemic and we've had share markets all around the world absolutely routed. Remarkably, those markets have gone back to pre-COVID levels and the S&P 500 was back at the pre-COVID level by September of this year. Exploring COVID-19 a little bit further, we can see that China has been the very first major economy to come back out of the impacts of the COVID-19 pandemic. China is Australia's largest export partner, so we're very lucky. That has helped us to maintain the momentum and also to support our economy as we've come through our own pandemic. Hopefully, with the easing of the lockdowns across Australia, our GDP can start to recover as well. The federal budget is going to be held in October this year, very unusual because of COVID-19. And that's going to be a really important milestone for the Australian economy and Australians generally. LGIAsuper will host a budget update on the 15th of October to look at what the budget itself means for the economy, for markets and so for your super. So please keep an eye on your inbox for an invitation to that. But what did COVID-19 actually mean for your super here at LGIAsuper? So there's no question that the market downturn during COVID-19 did actually have an impact on our expected returns, but we're all extremely pleased and quite proud, I have to say, to report that we were able to deliver most of our members positive unit price returns for the financial year. Our main investment option, which was the MySuper Under 75 investment option, delivered a 0.02%, just above flat, unit price return for the financial year. And that was an outcome that, given the volatility that we'd had, was really fantastic. But since then, it's been even better. Since the beginning of this new financial year, we've seen even more positive returns. And the MySuper Under 75 default investment option has returned over 2% in just a few months. And it's now averaging well over 7% over the last decade. So that's a really incredible recovery. I actually think it was one of the world's fastest recoveries in recorded history. Returns to your investments are really important because most people don't realise that most of the money that you actually consume when you're in retirement does come from your investment returns rather than your contributions. And in fact, a significant portion of that comes from earnings even after you retire. So it's important when you're thinking about that you have the right investment strategy to make sure that your super does grow over the long term, both pre-retirement and after retirement. So where is your super invested now? LGIAsuper invests in 7 asset classes: most of the growth component is made up of Australian and international shares. And you can see on the screen that these are brand names that we're all very familiar with. They're real companies that you're investing in, we're investing in on your behalf. And as per the nature of shares, their value does go up and down as the market fluctuates. But over the long term, they do provide fantastic returns as part of a diversified portfolio. To diversify member investments even further, we also invest in property and infrastructure, and they provide really consistent long-term growth in our local communities, which is another fabulous part of investing in them. These assets are usually larger in scale and value than the shares themselves, and they also have less risk and volatility in their pricing over time. Examples of some of our property portfolio that we invest in include office space in Brisbane and in other hubs, or, for example, regional shopping centres throughout Queensland and also Australia. Very diverse infrastructure investments make up your portfolios as well. So we've got big projects like roads or bridges, ports, green energy, car parks, water treatment plants, incredibly diverse. And that does help to diversify your portfolio. But to make sure that we have a really well diversified portfolio, we do have to have a portion that's dedicated to lower risk and lower return assets like cash or government and corporate bonds. So the proportion of these growth or defensive asset classes that you have in your portfolio does determine how aggressively your portfolio is invested and consequently how it is likely to perform over time. If your investment mix is aggressive, your long-term returns will probably be volatile over time. They'll go up and down with the share markets, but they will deliver a longer term expected higher return to make up for that. And that's important for super. If you're like many of our members, you may never have made an investment choice and you'll be in our default My Super Under 75 option, which has been specifically designed by our investments team to give you a really well diversified mix of all of the asset classes that we've just spoken about that suit a long-term investor. This can give you comfort to know that we've thought about making sure that that ready-made option will weather the storms that we've seen, like in February of this year, but that they will also give you great long-term returns to help boost your super balance over time. It is important that you think about your investment time frame when you're choosing an investment option. And if you're not planning on retiring for, say, the next decade or longer, then it's probably very important that you really focus on generating long-term returns. We've been through a lot this year. We've talked a little bit about COVID-19. And so with the graph that's on the screen, we've chosen to show you what it might look like to be in a period of really bad returns. It was from the start of February to the end of March this year. During that period, you may well have felt that it would be better to be in cash. We certainly understand that. But now let's zoom out and look at the long term. If we compare the performance of the My Super Under 75 default option, which is in green, against the cash over a 10-year period, you can see how much better your returns are likely to be when you invest in one of these higher risk options for your longer term returns. There are more ups and downs in the market and therefore in the multi-asset class option, but actually riding out those market fluctuations gives you a much better return over the long term, and that's really what super is all about. So that's a little bit about investment. I'm now going to pass back to Gabby to talk about our last topic, which is wealth protection. And don't forget to keep submitting your questions.
Thanks, Kate. So one thing that Kate mentioned was the upcoming budget, and I just thought I'd take the opportunity to point out that a lot of people are hoping there might be some tax cuts brought forward from what was planned to happen in about 4 years' time. So you're going to hate me for suggesting it, but that might give you a little bit of extra cash flow to think about putting aside for paying off the home loan or putting into super. Sorry, but I'm a financial planner, so I'm always thinking about the long term. So far we've been talking about wealth creation, which is kind of the fun part of super, to be honest. You get to talk about, accumulating your wealth and dreaming about that day when you get to retire and do all those fun things. But I also wanted to talk to you about wealth protection because unfortunately sometimes life throws roadblocks in the way. This first slide is just having a look at just how important your future earnings capacity really is. So in this example, I've assumed someone who earns $60,000 a year, has another 20 years of working life ahead of them, and just gets pay increases in line with inflation, so nothing too spectacular. But their future earnings capacity is expected to be worth about $800,000. Now, most of us wouldn't hesitate to insure our car or our house, which are probably worth a lot less than that. I do like to run through the types of insurance cover that you probably already have in super, because I think a lot of people are a bit confused about what they do actually cover. So death or life cover, that's pretty straightforward. If you pass away, then the lump sum gets paid into your super, and now your beneficiaries have that money available to fund things. Total and permanent disability, or TPD insurance, is a little more confusing. So that one pays a lump sum into your super if you get sick or injured and your doctors basically don't think you'll ever be able to work again. And at that point, your super becomes available to you, so you can start using that to fund the things that you need. Income protection will pay you a portion of your salary if you're temporarily unable to work because you're sick or injured. Now, an important point on income protection is it doesn't kick in until your waiting period has lapsed. So double check your waiting period, just make sure that you're comfortable with it. It also only pays a benefit period of 2 years. So if you're still off work after that, then your payment will stop. So you probably already have a default level of cover through your super, but that doesn't necessarily mean that that's the right amount for you. In fact, it probably isn't. So how do you decide how much cover you actually need? As a planner, I start by looking at what are the things you'd still like to be able to fund even if you couldn't work. So for most of us, we'd like to be able to pay off the mortgage. Obviously, we still want to be able to pay for the kids' education, and we still want to fund that cost of living. Then I take a look at what you've already got available to fund that. So, you might have some savings. Obviously, you've got your super balance that's available to you, and you might have some ongoing income, whether it's spouse's income or rental income or something like that. Now, most of us are going to have a gap between those two, what we want to be able to fund and what we've already got available. And that's where insurance comes in, is to fund that gap. Now, I know that's not an easy calculation to do, so we do have an insurance needs calculator on the LGIAsuper website where you can put in some of your personal details, and it gives you a little bit of an idea how much cover you need and how much that's likely to cost. If you do have more questions or you want a more comprehensive look at your insurance, give us a call. One of the financial advisors can do up a plan for you to have a look at how much cover you need. And that can also consider insurance that's available outside of super as well. So maybe if you're looking for income protection that's a bit longer than 2 years, or if you want to consider something like trauma cover, which pays out a lump sum if you suffer from certain events like heart attack, cancer, stroke. Those are sort of the main things that it covers. I'd also encourage you to go and register for a member online account if you haven't already. We're always looking for ways to update that with information that members can use. So a couple of things we recently added that I think are really great. You can see what your investment earnings have been since the 1st of July, and you can also check on what your contributions have been. So have a little bit of a play around there. I'll leave you with a little bit of a to-do list as well. So first place I'd like you to start, have a look at your current contribution arrangements. Make sure you know whether you're salary sacrificing or making after-tax contributions, particularly if you're working for council. So that might have been set up when you first started employment. And if you're not sure if what you're currently doing is right for you, you can start by heading to the salary sacrifice calculator on the website. If you put in your income and you put in, maybe I'm willing to put a little bit extra in per week, then it'll tell you whether to do that as an after-tax contribution or salary sacrifice, and it'll give you a bit of an estimate what difference that will make to your super balance at retirement as well. If you've still got questions, give us a call. Have a look at your current investment option. Make sure that you're happy with it. Maybe hop onto our performance graph and have a little bit of a play around with the different investment options. Take a look at your insurance cover. Make sure that you're happy with the level of cover you have, and if you've got more questions, hop on the website. Get the housekeeping done. So just sign up for a member online account, log in, have a bit of a play around. And please, if you've still got questions, give us a call. One of the things we know is that a lot of women seem to be reluctant to ask questions and to get help. But if you just take away one thing from tonight, it would be give us a call, we're here to help. And if you do need to take the next step and you want to get advice, we have 2 different levels of advice available. So if you just want advice on a single topic, like your contributions or your investment or your insurance cover, we can do that over the phone, and there's no additional cost to that. It's all covered in your membership. If you're having a look at your situation, you think, I'd like advice on all of those topics, or you're thinking you need something a little bit more comprehensive, particularly as you start getting closer to retirement, we can set up a one-on-one appointment for you with one of our financial advisors. So for that one, there may be a fee for that, but that is definitely a more personalised service. So I'll hand back to Kate now just to run you through a few wrap-up things and to start the Q&A.
Thanks so much, Gabby. I'm sure that people found that really informative. I know I did. Just quickly, before we take your questions, we did want to remind you that LGIAsuper is open not just to people who work in local government, but to everyone now. So if you would like your family and your friends to enjoy the same fantastic returns and good quality service and advice that you do, please send them to the LGIAsuper.com.au website, where they can join us in less than 5 minutes. And it's also really exciting to be able to tell you that LGIAsuper has been recognised by a range of ratings agencies for the quality and the reliability of our investment portfolios and also our accumulation and pension products, our customer service, our member education, and we've been nominated multiple times for Fund of the Year. So all of those things, I think, are testament to the work that we all do for you and for our members. So that brings our presentation to the close, and we do hope that you benefited from hearing about some of these topics that we talk with our female members about a lot. But don't go away, because now we're going to be answering some live questions from you. So I'll just start off. Gabby, we've covered an awful lot of ground today, I have to say, but can I ask you, if you were just starting out, what is the thing that you would focus on?
I think the number one thing I'd like people to go and have a look at is their contributions. That's something that we see all too often, is someone who's been maybe making after-tax contributions for a long time when they should have been salary sacrificing, or vice versa. So that's a great place to start. Like I said, logging onto your member online account and just being a bit more engaged with your super.
Thanks so much. So one of the most interesting things that I found when I joined, superannuation, was just how much of your returns do come from investment earnings. And I think we talked today about how up to almost 60% of your retirement is funded by investment returns, some from before retirement and some from after retirement. COVID-19 has caused some amazing fluctuations this year. It's been an incredible year for markets, and people could be understandably quite nervous. So in that context, how do you know that you're in the right investment option?
Well, that's a great question. And I would encourage people to really focus on their time frame to retirement. As you can go on our website and you can do a risk profiling tool that tells you the type of investor you are and where you might be comfortable investing. But particularly at the moment where there's a lot of uncertainty going around, there can be a risk that you can answer the questions a little too conservatively and therefore invest too conservatively. Whereas if you've got a really long-term investment time frame to retirement, you don't want to be too conservative. If you'd been in the default investment option for the last 10 years, for example, you would have more than doubled your super balance without any contributions. And I know that a lot of people are probably thinking, well, the next 10 years are going to be challenging. They probably won't be like the last 10 years, and definitely they won't. But just remember, if I was giving this presentation 10 years ago, we would have just been coming out of the GFC. And we wouldn't have necessarily known that we were coming out of it at that point. It would have felt like we were in the thick of it.
Fantastic. Well, we've got some great questions coming here from our audience, so please keep sending them to us. First question here from Jane. Is there a limit to the amount of salary sacrifice that you can make during a financial year?
Thanks, Jane. That's a great question because I didn't cover that in the presentation. So there is a limit. You can do $25,000 worth of what's called concessional contributions per year. So the important thing to keep in mind is that that does also include your employer contributions. And if you're already doing 6% member contributions as salary sacrifice, then that does count towards it as well. Again, if you're thinking about doing some extra salary sacrifice and you're concerned about the caps, give us a call, because there are advisors who can give you advice on contributions over the phone and help you with that. Make sure that you don't go over the caps, but you can also take advantage of any extra incentives there.
Fantastic, thanks so much. Another question here from Veronica. If I put extra money into my super, where can I find out how much it will be worth at retirement?
That's a very good question, Veronica, and a little bit of a tricky one to answer, because obviously whenever we're doing forward projections, you have to make assumptions about returns and things like that. But like I said, if you hop onto the salary sacrifice calculator, so you'll find that under resources on the LGIAsuper website, you can put in, I'm happy to put an extra $20 a week or $50 a week into my super, and it will tell you about how much it thinks it will increase your super balance by for retirement, based on the retirement age that you actually put in.
Great. Fantastic question here about transitioning to retirement, actually, from Karen. If I retire at 63, can I continue to contribute to my super if I'm not working? So depositing money into super from other income streams like dividends.
You certainly can. In fact, they just recently pushed out how long you can contribute to super for. So you can now contribute up until age 67, even if you're not working. And if you are still working, so there is a work test, but that allows you to contribute right up until about age 75.
Thanks very much. So, wonderful question on investment markets from Tina. Tina asks, how can we expect COVID to impact investment markets and therefore my super in the future? I might take that one actually, but just for something different. So, obviously, the Australian economy has been really well supported by the government stimulus that we have received through JobKeeper and JobSeeker, and we all know that that is being wound back. We do think that 2021 is looking quite difficult, actually, as that stimulus starts to be withdrawn and markets and economies have to sort of stand on their own 2 feet. So, what I would say is that I think that COVID-19 is likely to continue to weigh down on markets, and as we have further waves and further lockdowns and withdrawal of stimulus from around the world, it won't help us actually. But that doesn't mean that you can't have returns and deliver returns over time. So the LGIAsuper portfolio is set for a more conservative future and 2021. And one of the things that we're doing is making sure that we're focusing on income, for example, so that you get income streams to support the fact that maybe you're not getting the same capital growth that you otherwise would. So we are thinking very hard about what the future looks like and what COVID looks like and the impact on markets, and we are setting our portfolios for that. Thanks for that question. So we've got another question here. What are the disadvantages, this is from Marissa, what are the disadvantages versus advantages of putting extra into your super weekly compared to a lump sum at the end of the financial year? You can take that one, Gabby.
So the main thing here is the earnings. So when you're putting money in weekly into your super, you're getting returns on that every single week. So that's helping to build your balance. Probably a lot of people also find that it's a little bit easier from a cash flow point of view to commit a weekly amount into super. There's also this concept of dollar cost averaging. So when you're making regular contributions, you're buying in at all different points of the market. So if we have a downturn at some point during the year, that means that you're buying in when markets are cheap. And then so when the recovery happens, you've bought your units when they're at a discount, and that's going to go up quite nicely. If you put in money as a lump sum and then the next day we have a downturn, there's not really much you can do about that. That's just sort of the way that it is.
Thank you. Another great question from Tina. How do I know what investment option is best for me?
So yeah, that's a tricky question. Again, you can go and do the risk profile questionnaire on the LGIAsuper website, which will give you a bit of an idea about your risk tolerance. But I think it really comes down to time frame. If you've got a long-term time frame, you shouldn't be too conservative with your superannuation. So maybe go and have a look at the performance graph. The long-term investment horizon that you can have a look at there is 10 years. And maybe compare some of the investment options so that you can see how much better something like a more aggressive investment option has performed. But you can also see the ups and downs, so you can see the different fluctuations, and just make sure that you're comfortable with that.
Fantastic, and we've got our last question now from Renata, who asks, would you recommend voluntary super contributions over investment or purchase of shares?
Again, that's going to come down to personal circumstances. So, pros and cons. If you purchase shares outside of super, then you have access to that money. You can sell down your share portfolio at any time. It's very liquid. I would also point out to people that buying specific shares is a very aggressive investment option. You're fully exposed to the share market, so that's going to be very volatile. Whereas when you invest into super, you're investing into a diversified option. Like Kate was talking about, there's a little bit of everything in that portfolio. But then the issue with superannuation is that it is going to be locked away at least until age 60. But then also keep in mind that there's tax advantages of investing in super. So your tax rate in super is only 15%. Outside of super, your tax rate might be 35, 39, 45% even.
Well, thank you so much, members and guests, for your questions tonight, and we've absolutely done our best to get through as many of them as we possibly can, but we're now out of time. Don't forget, a recording of the webinar will be available on the website within the next week or so. And don't forget that we also have a team of experts, just like Gabby, who are ready to hear what you have to ask and to achieve your best retirement. Before you go, we do actually have some slides that we're going to show you shortly, which can help you with your super. But thank you from me and Gabby. Thanks so much for joining us tonight, and have a great evening.